Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss ESG investing during crisis.
Hello everyone, my name is Radovan Vojtko and I'm CEO and Head of Research at Quantpedia. Today we will discuss ESG investing and how does the ESG investing performs over the business cycle. So firstly, what's ESG investing? So it's a new trend in finance. ESG investing focuses on companies that follow positive environmental, social and governance principles. So investors are interested to invest their portfolios with the companies that not just perform well from a financial point of view, but also that have a growth with the positive effects on society and environment. So that's like the definition of ESG investing. Over the last decade, it's really quite a team. So there are a lot of funds and all of the strategies and a lot of papers that are related to this style, to the ESG investing. We dedicated a few blogs to this team, so you can find those blogs very easily on Quantpedia. We have a lot of papers and a lot of strategies related to ESG investing. So a lot of the strategies can be built from research papers related to this style. Now I would like to discuss one paper which is described on our blog, and it's about ESG investing during the calm and crisis period. So the paper is written by Henk Bergman and Mihir Dirotkan. They try to answer two questions. So the first question is, what is the expected return of ESG investing in general? And the second question is, how is the ESG investing return affected by crisis? Or what is the return of the ESG investing during the crisis period? So they are using the option implied expected returns. What is the most important chart or most important picture is probably this one. So it's the figure number one, which is the option implied 30-day risk premia for ESG return. What does it show us is that ESG investing option implied return during the crisis is negative, but it's forward-looking performance. So what does it mean is that during the crisis, at the moment of crisis, the ESG portfolios actually outperforms the overall market, and after the crisis is behind us, they underperform the market. So the market catch up the ESG portfolios, and the average performance of the ESG portfolios is actually in line with S&P 500 or with the overall market. So the ESG investing may not be a source of systematically superior returns for investors. It's a way of expressing ethical preferences, but they can temporarily reduce risk during the unexpected crisis. That's probably the most important thing that we can take from the paper. Yeah, you can invest ethically. Your performance is plus or minus the same as the performance of the overall indexes. And what is the added value, which is, little surprising, is that the ESG investing portfolios can work as a crisis hedge during the crisis because they do not fall so much during crisis. Of course, expected performance after the crisis or the forward-looking performance during the crisis is the negative. So when you have an ESG portfolio and you go into the crisis, you will probably lose less money. So that portfolio works as a hedge. But after the crisis, the overall index usually catch up with the ESG portfolio. So at the end, you have the same amount of the money. But during the crisis, when you had the ESG portfolio, you probably lost a little less money. That's interesting thing that we learned about ESG. If you want to learn something more, I really recommend you to read the paper. The paper can be downloaded from SSRN. That's all for today about the ESG, about the trading and investing in general. If you like this short video, please subscribe to our channel. You can watch other videos about all of the other topics related to quantitative and algorithmic trading. And please give us the like. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.